Inflation. Alright, chapter 2, the investor and inflation. So now we are getting into the meat of this book, probably, at least compared to the previous chapter. Everyone, I think, has a general idea about what it constitutes. Your £5 meal deal, £6 the next year, the silent tax and whatnot.
Inflation basically means the purchasing power of money goes down. What you could buy yesterday costs more tomorrow. We should really think about when Graham was writing this book, the historical context and its significance. Great Depression and World War Two, massive events with obvious economic changes. Still, even now we will be able to match his words, especially after 2022 when inflation rates spiked globally.
Yeah, the UK was 11% in late 2022, highest in 40 years.
Yeah. And here we can bring in Graham's question on how should investors react to inflation? Panic? Prepare?
And it isn't hard to guess that his answer wasn't run to gold or buy crypto, it was to think rationally. Inflation is dangerous, yes, but it's not unbeatable.
So, Graham, being the realist that he was, said inflation is inevitable, not exceptional. We better accept that. Instead of formulating some utopian method to combat it, it won't happen. Prices will always rise over time. That's the truth. Economies grow and currencies lose some value. That's how it works.
Yeah, he looked at data from as far back as 1900 and recognized that money consistently lost purchasing power. What cost £1 back then was several pounds a decade later. Now, here we can talk about how we shouldn't fear this. Graham says to plan around it.
Exactly. He kind of mocks people who think they can outrun inflation by constantly switching investments, like jumping from boat to boat as water starts filling it up. His idea was not to end it at acknowledgement, but also throw in some acceptance too. You can't escape the tide, but you can build a stronger boat.
That's it. Preserve real value. It's not just about chasing nominal returns.
Yeah, because if your investments earn 5% each year, but inflation at 6, you're technically losing money in real terms.
Graham dives into comparing bonds and stocks during inflationary periods. Bonds, he said, are fixed. The money you lend is the money you get back in nominal amounts.
We should also clarify what nominal amounts are. Let's say nominal GDP grows about 5%, but inflation is 3%. The real GDP growth is only 2%. The real amount is adjusted for inflation, as they say, whereas the nominal amount is what is current and unaltered. Anyways, back to the point. All this essentially means is inflation just eats into that return, like rust on metal. If inflation spikes, bondholders lose out because their fixed income buys less and less each year.
Stocks, on the other hand, are ownership of real businesses producing real goods. Over time, their earnings and dividends can rise with inflation, so they're not immune, but they have a fighting chance.
Exactly, but there is always balance, no matter what. Graham warns not to romanticize stocks either. Going back to chapter 1, prices swing with emotion. The best protection isn't any single asset, it's balance. And this is such a contrast to today, where people go all in on tech or crypto because they think it will outpace inflation forever.
Speculation, that is, and yeah, his advice is paramount. Don't try to predict the unpredictable, prepare instead.
So, then there's real assets. Things like properties or commodities as partial hedges. Not perfect, but better than holding pure cash.
Yeah, cash during inflation is like ice, looks solid now but melts over time. Graham wasn't an adversary to simple cash, he just preached a strategic approach and not endlessly storing it.
He hinted that equities over long periods were the best bet against inflation, but only at fair value, needless to say.
Which ties back to his first chapter again, investing versus speculating. It's so important to link all these concepts together. It's not just about applying this here and that there. Buying good companies at good prices, then holding patiently. That's your inflation armor. Not impenetrable by any means, but you're reducing the damage that could be dealt.
So, we said this in the last episode too. If Graham rose from the dead somehow, what would he say? Probably inflation is intimidating, but not new.
Yeah, it's Part of the economic rhythm, it punishes greed and patience get surprised. 2022's inflation spike was a perfect reminder. Even the safest looking assets can sting if you forget a real value.
And as quiet wisdom still applies, consistency over cleverness. Don't chase fads, have a balanced portfolio. And I think the most common pitfall is that people don't keep their expectations realistic.
It's also about mindset. Inflation makes people emotional. They panic buy, hoard, or jump into risky assets. Graham's advice is stay calm and think long term.
Yes, see further than you can at first glance. The intelligent investor's goal isn't to beat inflation every year, it's to protect and grow purchasing power over decades. If you lose the battle, win the war.
So, chapter 2, in one line, inflation is inevitable, panic is optional.
Alright, and that's us for this one. Next episode, we dive into chapter 3, a century of stock market history, where we may be able to add some much needed and most likely informative context.
Thanks for tuning in.